significant probability of having a recession. And one thing to keep in mind is that recessions are measured in real terms. And so, for example, if inflation's 8% and nominal growth is 5%, that's a recession. I think we're kind of in an environment where inflation is going to be a persistent issue. They're going to try to talk tough, but at the end of the day, the math, matters, right? So, for example, if they cause the credit market to become illiquid, if they cause the treasury market to become illiquid, if they, cause an outright recession, we start to see high employment, that makes it very challenging for them to continue doing what they're doing. And so I think they're kind of stuck between a rock and a hard place, and that the release valve ends up being this weird situation where they're unable to keep tightening despite the fact that inflation is much above their target. And one thing I've found is that looking back in history has been able to make some sense of the situation. So it goes back to the old quote, history doesn't repeat, but it does rhyme. And so the history can't tell us what's going to happen. It's not like, okay, here's step one, two, three, and here's step one, two, three. But a lot of people keep describing this as unprecedented or saying we've never seen something like this, where actually we have. It's the 40s. The last time we had a disconnect this big between rates and inflation in North America and Europe was the 1940s. And so because of Ray Dalio's good research and the research of others, and then adding my own research on top of it to kind of look at that thesis, for the past few years, I've been expecting this higher inflation, but not the correspondingly high interest rates, which is what we've seen. It's kind of a specific outlook, and now we're starting to get that kind of that slow rate rise, but it's starting from such a low base, and we're kind of already testing the limits of how high that I think they're going to be able to get. And so I think that pretty much sums it up. That they've encouraged so much credit growth for decades that they have a massively high level of debt to GDP, and that's true in the United States and in Europe and Japan and elsewhere, super high debt levels. And then therefore, when we finally have a true inflationary impulse, basically lack of commodities, supply chain problems, and a lot of money creation, they're unable to raise rates to try to tame in that inflation, or at least to the degree that they need to. I think there are very few ways for them to have a soft landing here. I think Luke Roman described it best, that basically outside of some sort of massive unexpected productivity increase
Right.
that happening, it's really hard to see a way out, right? Because basically, in order to have real growth, meaning inflation adjusted growth, we'd have to bring more energy online. In the 40s, a lot of that spending could be turned off, right? It wasn't kind of based on aging demographics and things like that, right? So we could do some degree of austerity after the war, as well as rebuilding. And as you pointed out, we had abundant natural resources. We were not really kind of tapped into heavily the whole kind of world reserve. At this current time, we don't really have new supply coming online anytime soon, at least any sort of significant new supply. And so, if you're asking me this question in the 2030s, maybe eventually there we have kind of we've kind of gotten through some degree of pain and we're building up from there, right? So maybe by that point, that'd be part of the discussion. But I think as we sit here in the 2020s, it's more like the early 1940s, right? There's still a lot of stuff ahead. Now, hopefully not the same type of stuff as the 1940s, but in terms of fiscal and monetary policy and, different entities fighting over resources, essentially. The Fed can always choose to override the bond market with formal yield curve control, right? And this is something I've been eventually anticipating. We've seen it in Japan first, where the Bank of Japan just comes out and says, "I know you want to price bond yields higher, but we're not going to let you. We're just going to do an unlimited bid with printed money to peg yields at what we want to do." So the Federal Reserve can come out and say, "I know you want to raise yields, but we're just not going to let that happen. We're not going to let the 10-year go above 3%, for example." And the offset would be massive currency devaluation. There's no free lunch, and so if they control yields, they get massive currency devaluation, which is basically massive inflation. And if they don't control yields, then they have basically a fiscal spiral. You have something like what, say, Europe experienced in 2012, until the ECB stepped in and basically said, we're going to hold this together. So you'd have basically rising yields in the U.S. and elsewhere, and you'd have budget deficits blow out, and then there'd be no clear way for them to recover that, right? Once debt as a percentage of GDP is that high and deficits are still widening, that's a disaster for the
Right.
solvency. And so I think at the end of the day, they're gonna let the currency go and control yields because I think it's kind of the only way out But of course, that's disastrous for cash and bondholders. But I think that there's a bumpy road between then and there because that's basically a complete capitulation, right? That's kind of the end of central bank credibility. It's hard to say ahead of time what the exact level of inflation is going to be, right? I mean, there's all sorts of variables that could have delayed it, that could have dampened it a little bit, basically, economies opening and things like that. But yes, a lot of us were looking at this inflation picture and saying that we're not seeing the commodity capex. We're seeing a lot of new broad money in circulation, which was different than what we saw in 2008. Basically, just more money chasing fewer goods. And so, they called the whole inflation transitory thing. They were wrong on that. And I think it shows that we just don't really have the most data-driven people running things. And I think that, we zoom out really far. I think the biggest problem is that controlling the price of money is not a good thing to be doing, but it's just an inherent part of our current system design. But I think that's kind of an inevitable problem that you're going to have, just like, in most industries, price controls are not a good thing. And the problem is that there are a handful of things that if you control the price of them, it can distort everything else. And those would be things like energy and money, right? So those are kind of the master inputs that affect every other price. And so because by controlling the price of money or by controlling the price of energy, that can have a billion ripple effects down the road. And I think that's just the problem we face ourselves in the way that we've structured the system over the past century or so. The Fed's trapped, ECB's trapped, Bank of Japan's trapped, where especially the ECB, but basically they're kind of stuck in this position where they have to support their sovereign bond markets, and that can come at the expense of currency devaluation. And so I don't think they're going to be able to normalize anytime soon, although some of them, like the Fed, can do these periods of pushback, which I think is why people have to be careful with how aggressive they get, what their timing is if they take on any leverage, because central banks can temporarily fight back pretty hard. I think there's a significant probability of having a recession. And one thing to keep in mind is that recessions are measured in real terms. And so, for example, if inflation's 8% and nominal growth is 5%, that's a recession, right? So you're basically negative real growth for a prolonged period of time. And so GDP in local currency terms is still going up, and maybe stock prices and even housing prices in local currency terms are still going up. Like if you look at Turkish equities or Turkish real estate prices in lira terms, they're going up. But in dollar terms, they're of course struggling. And so I think that, in a more mild sense, that's the kind of the environment we're in now, where real growth is struggling. Could be negative, could be very low positive. If we end up having a negative real GDP print this quarter, then we're arguably already in a mild recession at this point.